May 2nd, 2026. Spirit Airlines tells passengers not to come to the airport. Every counter closed. 17,000 employees out of work overnight. 91 planes stranded across 26 airports. A $500 million rescue package had been on the table just weeks earlier. It collapsed. Here's the part nobody tells you. The money didn't disappear because Spirit was worthless. It disappeared because Spirit was worth more dead than alive. A failing airline isn't a pile of debris, it is a ledger with wings. Spirit's shutdown didn't come from a catastrophic event or a single villain at the controls. The math was simple, but the outcome was anything but. When Spirit's flight schedule vanished, the value didn't. It just moved out of the daily operation and into the parts, leases, and rights that still held market price. An airplane isn't really one thing. It is a stack of contracts, engines, and certifications, and every layer has its own buyer. The seats may be empty, but the engines can fetch more on the secondary market than a year of flying packed cabins at razor-thin margins. Gates and landing slots at congested airports become bargaining chips overnight, sometimes worth more than entire regional routes. That is the paradox. The same company that couldn't cover payroll on Friday could, by Monday, be worth more in pieces than as a functioning airline. The rescue plan held out $500 million, but the sum of Spirit's assets, when stripped, split, and sold, added up to more. It is not about blame, and it is not about heroics. If saving it loses money and breaking it up makes money, you don't need bad people for a bad outcome. You just need a spreadsheet. In the end, the logic of contracts and collateral wrote the final boarding call. Spirit's planes wore yellow paint, but the real question was, who held the keys? Out of about 170 aircraft in the fleet at shutdown, Spirit only owned 48. The other 122, roughly 72%, were leased, their titles sitting with companies like AerCap, Avalon, and Air Lease Corporation. That ratio flips the usual picture of an airline on its head. For every jet Spirit owned outright, there were more than 2 that belonged to someone else's balance sheet. This isn't just an accounting footnote. In aviation, livery fools the eye, but title decides who gets paid first. When Spirit's cash ran out, the lessors didn't wait to see if the airline could recover. They prepared to repossess. Operating leases, by design, make it easier to pull an aircraft back and redeploy it elsewhere. For the lessors, a grounded plane is a mobile asset, not a stranded liability. Compare that to an airline with mostly owned aircraft. Selling off a jet means finding a buyer, negotiating price, and waiting for funds to clear. But with leases, the paperwork is already written for a quick exit. The value of Spirit's fleet didn't depend on its ability to fill seats. It depended on the contracts that let lessors reclaim and remarket planes at will. In the end, it wasn't Spirit's logo on the tail that mattered. It was the name on the title, and that name was rarely Spirit's. Engines are the hidden currency of airline liquidation. While the fuselage draws the eye, it's the power plants bolted beneath the wings that hold real market clout. On a narrow body like Spirit's A320 Neo, a single engine can be worth as much as 3 times the airframe's scrap value. Recent secondary market deals have seen used LEAP 1A engines trading hands for as much as $7 million each, while the stripped airframe might fetch barely $2 million. It is a reversal of logic for anyone who thinks of a plane as a single, indivisible asset. But the layers go deeper. Engine ownership often splits away from the aircraft itself. A lessor can hold title to the engines while another owns the jet, and maintenance, repair, and overhaul cycles mean engines are regularly swapped between aircraft, sometimes weeks or months, before an airline's collapse is public. Spirit's own MRO contracts required engines to be removed for heavy checks in April, long before the shutdown banner went up in May. That's the quiet start of liquidation. Engines are pulled, paperwork is shuffled, and value migrates off the balance sheet before most people realize the airline is in trouble. Once the engines are priced and moved, the breakup value of the airline stops being theoretical. It becomes a series of transactions, each one chipping away at the idea of Spirit as a flying company and transforming it into a marketplace for high-value components. In the end, the engines don't just power flight. They power the math that decides who gets paid and who gets left behind. Airport access is the invisible currency of the airline business. Gates and landing slots at places like Chicago Midway or Dallas Love Field aren't just logistical details. They are tickets to the game, often more valuable than the jets themselves. When Spirit's operation evaporated, those prime positions didn't sit idle for long. Within 30 days, Southwest, Allegiant, and Frontier filed formal claims for Spirit slots, each move a scramble to claim territory in a market where the FAA caps supply and demand never sleep. A single slot at a major hub can trade hands for the price of a house in the suburbs, sometimes $6 or $8 million, more than the scrap value of a narrow-body airframe. But the real race plays out in the overlap. Wherever Spirit's routes matched up with a bigger carrier, the replacement flights were announced within days, sometimes hours. The best routes attract the fastest response. Meanwhile, smaller cities, Pueblo, Bismarck, and Myrtle Beach watched their ultra-low-cost service vanish, with no rush to fill the gap. The network itself became part of the breakup value. In the end, access, not just airplanes, was what the market fought for. And the winners were the ones who moved fastest when the gates swung open. In the final months, Spirit's numbers didn't just look bad, they looked unsolvable. The rescue proposal for $500 million, which once seemed like a lifeline, now faced a wall of math that even optimism couldn't climb. By late 2024, Spirit had already burned through one restructuring, trading $795 million in debt for equity. 5 months later, another bankruptcy filing. Each fix was supposed to buy time, but time itself got more expensive. In March 2026, the Iran conflict doubled jet fuel prices overnight, turning every flight into a loss leader. For an ultra-low-cost carrier, where fuel already made up nearly 1/3 of expenses, that wasn't a headwind. It was a brick wall. The rescue package wasn't just about plugging a hole. It had to reverse a flood. Creditors, led by Citadel, saw the government's equity-heavy terms as a threat to their own recovery. Accepting the deal meant letting their claims get diluted, trading a hard asset for a future maybe. But the liquidation math didn't care about hope. Stripping Spirit down, aircraft, engines, slots, and gates offered a payout, in cash, within weeks. The breakup value, conservatively estimated at $1.6 billion, meant that selling the parts could pay out more and faster than keeping the airline alive ever would. Here is the reversal. The rescue wasn't blocked by malice or mismanagement, but by a spreadsheet. The internal rate of return for senior creditors in a liquidation ran north of 25%, while the rescue scenario projected negative returns and more waiting. In this model, even a perfect safety record or a loyal workforce couldn't tip the scales. The math was agnostic, and Spirit's structure, lease-heavy and margin-thin, meant that any airline with the same balance sheet could face the same verdict. Frontier's numbers, for example, now look uncomfortably familiar. In the end, the capital didn't show up, not because the airline was uniquely doomed, but because the numbers made the call. When the sum of the parts is worth more than the whole, the spreadsheet wins. Aircraft can be ferried to a new owner in a matter of days. A gate lease is reassigned with a signature. But the people who made Spirit run, pilots, flight attendants, mechanics, and the corporate staff in Dania Beach do not redeploy on the same schedule. For pilots, seniority is currency. The ALPA contract spells it out. When an airline disappears, years of accumulated rank and bidding rights are frozen. Anyone hired by another carrier starts over, trading a captain's seat for the bottom rung. Flight attendants, too, face furloughs that promise benefits but no pay, and the recall list is only as good as the next airline's hiring plan. The 1,800 cabin crew furloughed in Spirit's final month joined a labor pool already crowded by other cutbacks, their seniority numbers now little more than a memory. In Dania Beach, the headquarters emptied out with no prospect of reassembly. Corporate jobs do not transfer the way airframes do. The team that managed schedules, contracts, and compliance is scattered, each person's expertise suddenly surplus to the market. Passengers holding free Spirit vouchers or loyalty points found their claims routed through bankruptcy court, not customer service. Refund notices arrived as legal documents, not apologies. Where a flight credit once felt like a promise, it became a line item in a liquidation schedule, redeemable for pennies on the dollar, if at all. Assets get auctioned, but people wait. Engines move across continents in weeks. A pilot's career, a flight attendant's benefits, and a staffer's pension can take years to recover, if they recover at all. The spreadsheet closes the books, but the human cost lingers unredeemed. Today, the market still values a fleet's breakup rights above a carrier's survival odds. In an industry where an airplane is just a stack of contracts, spreadsheets decide who flies and who folds. If profit lives in the parts, the next casualty is only ever one calculation away.